everyone, welcome back. I'm Alan Yates from Peregrine Capital, and this is the Peregrine Capital Hedge Fund Trading Academy. And today we're going to be talking about risk. I think the first thing is to say that the goal of a hedge fund is obviously to produce superior risk-adjusted returns. But that's kind of where it ends from a rule-based perspective, because there are very different return profiles out there and very different mandates out there. So for us as Peregrine Capital, we've got two funds available to you, and as you can see here, our intention is to produce those superior returns in relatively low levels of volatility. So that's a mandate that we have in our two funds. That's what we think we're relatively good at doing, but that isn't the whole picture. The whole picture is that hedge funds are just a vehicle, and I think this is a part that everyone needs to be very aware of. You have this wider toolkit, but that's kind of up to the manager in terms of how they best utilize that toolkit. And I think there's a few things that needs to be thought about when thinking about risk and hedge. So first of all, there are lots of different risk profile funds out there, from the very low to the very high and everything in between, just like traditional unit trusts. So from a risk perspective, you've got to make sure that whatever fund you're looking at is appropriate for the job you want it to do. Then the second thing is, and this is again similar to the long-only space, is that there are varying levels of skill from managers and varying levels of experience from managers. So what that really means is that while a manager might have this toolkit available to him, does he know how to use it? Do they know how to manage the portfolio in a way that is, consistent with their mandate and is going to produce the best possible returns for their investors? And then I think the other thing to say is that there are also different skill sets and different asset class focuses per manager. So, in summary, it's really the hedge fund it's a vehicle, right? And that vehicle gives you this expanded toolkit as a manager, which we certainly think is a very valuable toolkit to have, but it is something that you've got to assess on a manager-by-manager basis as to whether or not they really know how to use it. So let's dive into a couple of basics around the toolkit and what that can produce from a risk perspective. So if we think about hedge, we think about flexible mandates. You think about the fact that they can use leverage, they can sell short, and they can use derivatives. So now there can be very different intent from a manager about what they want to achieve with their toolkit. So the first is potentially the manager wants to reduce volatility, increase consistency, and protect and grow capital through the cycle. And that's very much the Peregrine model. So for us, it's a case of saying our investors come to us and say, we want you to protect us on the downside while obviously giving us the best possible risk-adjusted returns with that as a mandate. The other end of the spectrum is you can use that leverage, you could use that mandate to increase the volatility, to decrease the consistency, but really aim for outsized returns. So if the market it has done 20% and you've got lots of leverage in your hedge fund and you've called it right, hopefully you can do 40 or 50% returns. But obviously the flip side of that is that you've got this potential upside, but you also therefore have heightened potential downside. So again, I'm not saying either are better or worse than the other. It's really just a case of making sure that when you look at a hedge fund manager and when you look at the funds they run, is the fund the right vehicle for what you're looking to achieve? So, if I give you an example, our pure hedge fund, which is a market neutral fund, very low volatility, very low drawdowns, never had a negative year in the 26 years it's been running. But that fund wouldn't be appropriate for somebody that's looking to get market times 2 type of return. So someone who's looking for something really racy, they're happy to take the volatility, they're happy to have the big swings in markets, but they want to generate outsized returns on the upside and the downside. That fund wouldn't be appropriate. And likewise, if somebody's looking for something like this, going for the funds that are really swinging for the fences wouldn't be appropriate either. If I then move on to the risks in the toolkit. So let's start with leverage. So leverage really is what happens to the portfolio when shorts are introduced to it. And so if I give you the example on the screen right now, if I were to say to you that we've got exposure to NASPers and this is obviously a hypothetical example, but there's NASPers, Meta, Standard Bank on the long side, Nedbank and Woolworths on the short side. That net exposure would sum to 60% of the AUM in the portfolio. But from a gross perspective, you'd actually want to say, how much exposure does this manager have to the overall market, assuming that their positions are totally uncorrelated, so to say. So, as an example, if you look in our example here, our Standard Bank and Nedbank position is a pair trade. And because they're both in the banking space, they should track each other quite comfortably and quite closely. However, maybe they don't, and therefore you want to assess what's the gross exposure is this fund manager taking, and that's the right-hand column here. And then gross exposure is really adding up the sum of all exposures, both long and short, to get what the total gross number is, and that tells you how much leverage sits in the portfolio. So in our example here, the leverage is 1.2 times the NAV of the fund. So if the fund had 100 Rand invested in it, it would have 120 Rand exposed to markets at this particular point in time. And so that leverage obviously is a risk, and it's something that you need to assess. So I think what you're looking for here is to say, how does the fund manager make use of this leverage? Are they doing it in a conservative fashion, or are they really like maxing it out and having swinging for the fences here? And what would happen if they get that call wrong? So obviously, the more leverage that's introduced to a portfolio, essentially, the more likelihood or the more chance there is that this thing has got geared positions in it, and if the fund manager doesn't get their calls right, it could be negative for the fund. Now, the nice thing to note is obviously in South Africa, leverage is regulated. So hedge funds, because they're regulated, it means that there are guardrails in place that say a fund manager, any fund manager who's running a hedge fund, can only take X amount of gross exposure. So for a retail hedge fund, which I think is the one that's really relevant to you guys, that would be 200% gross. Now, I think it's worth mentioning to say to you that 200% gross, while relative to international peers, if you look at some of the fund managers in places like America, you can get 300, 400, 500, 600% gross exposure from some of them. 200, in my mind, it's still quite a significant number. And so what you want to do is you want to make sure that when you're assessing the hedge fund manager that you're looking at is how close to that 200 do they run? Are they able to juice the best possible return with the leverage that they're using? And are they using it in a way that is conducive to the mandate that they're running? So that's leverage. The next risk from a toolkit perspective is obviously shorting. So now when one shorts a position, it can be a very powerful and useful tool in a hedge fund, but there are things that you need to be aware of. And the first is to say, obviously, that a short position's return profile is the inverse of the long position, right? So what that means is if I short a share at 100 Rand, the most I can make out of that short position is 100% of my capital. So the short essentially goes to zero. That company goes bankrupt. I can make 100% return on that short. But the inverse of that is if that call is incorrect and the share goes to 110, 120, etc., that downside is not immediately capped. When you have the short position in the portfolio, it means that you are running some degree of risk that you're getting that call wrong. So you need to look at your fund manager and say, how many short positions? What are the size of your short positions? How do you manage it in terms of sizing, in terms of liquidity, in terms of how those short positions interact with one another? If they're all exposed to a very similar driver, and that driver goes against the fund manager, then essentially your short position is something that is going to detract from the portfolio. So from our perspective, I think shorts for us as a fund manager, it's not a big part of, these outright short positions are not a big part of how we utilize the toolkit. We like to use the short positions as part of pair trades because we think that that's where we can generate alpha without taking market exposure. So it means it's where we are able to produce returns for our investors without adding additional risk to the portfolio. Then a second thing, which truthfully is less of an issue in South Africa, but something that's certainly worth knowing about, is what's a short squeeze. So a short squeeze really means that if a fund manager has a short position in a share, let's call it ABC, and the company that they've borrowed those shares from recalls them, that fund manager then is forced to buy those shares in the market. And if there are many fund managers who have the same short position on the same company, and they all get recalled at the same time, you are forced to buy back that position. And that can lead to obviously the price increasing on you quite quickly. And that's what a short squeeze is called. Now, obviously, that's something that, again, the fund manager needs to make sure that they are taking short positions in companies that have good liquidity, in companies that there's not a huge amount of borrow out and the potential for a recall is high. That's something that the fund manager obviously has to manage in their overall portfolio management process. And then the last one is derivatives. So I think the important thing with derivatives here is that they are complicated structures. In terms of how one prices an option, the pricing on these things, the way they move in various market environments is a skill set unto itself. And so you want to make sure that the manager that you're investing with knows what they're doing when they are investing and making use of derivative products. And the second thing is to say that what is that derivative product there for? So, if a manager like ourselves is buying put options to protect against the portfolio drawdown, that's obviously a risk reduction metric. If a manager is writing those put options to try and pick up some of the premium, or is alternatively buying very convoluted, complicated structures that are bespoke, that adds additional risk to the portfolio in terms of the way those things are priced, and it's very important that manager understands the investment that they're purchasing. So for us, derivatives, we certainly like to keep it pretty vanilla. We like to always be buyers of these things, never sellers of these things, because if you are writing those options, essentially you become the insurer, not the insured. So for us, it's a case of saying we want to be able to buy the insurance, we want to protect on the downside, but we try to keep it pretty vanilla for all of these reasons. So I think that the summary here is that quality of the manager is key when looking at a hedge fund manager, because the skill set needed here with these additional tools is very different to the normal long-only fund manager. The skill set you need to price options, the skill sets you need to consider liquidity and gearing and gross and net exposures is not the same as the skill set needed to look for a mispriced asset in the equity market. And so a quality hedge fund manager needs to have both those skills. Obviously, you need to have all the skills that the long-only manager would have in terms of how you choose, what to invest in. But likewise, you need the additional skills of being able to manage these additional tools in the toolkit. So I think it's a very good question for you when looking at any fund manager is to say, how have they utilized these tools during various market cycles? Have they delivered what it kind of says on the tin? So if the fund says, the fund mandate is that this is a low-risk, market-neutral fund, when markets have fallen in a heap, has there been good capital protection from the fund manager? Is the volatility in this product low, regardless of where the markets are in the cycle? These are the sort of questions you do want to ask. And I think it's also very important to say to you that honestly, there are so many very good hedge fund managers in South Africa with really long track records of being able to do this, that I think from an investor perspective, honestly, there's a number of managers you can choose from, but just make sure that the ones you're picking are the ones that show you that they know how to use the tools in the toolkit and that they're not introducing any of these unnecessary risks to the portfolio. So what are the outcomes from good risk management? I think is obviously what the next question that comes here is, what does good risk management kind of look like when a hedge fund manager is using these things and using them well? And I'm obviously going to use our funds as an example here because I can't use anyone else's funds. But if you look here, we've been doing this for a long time, and I think we obviously know how to use the toolkit appropriately. So for something like our pure hedge fund, where we are looking to generate those super low volatility, very consistent and stable returns, you're getting that it's doing what it says on the tin, right? Max drawdown is super low. I mean, that's very comparable to kind of an income fund type of drawdown. 100% positive years, never had a negative year in 26 years. 85% of monthly returns are positive. You can see there are high growth fund, which is a fund where we're trying to obviously outperform the market over the long term. And again, so comparing it to the cap Swix, what's the volatility look like from that fund versus the overall market? Well, the maximum drawdown is less than half, and you can see there it's been significantly more consistent in terms of its ability to produce positive returns for investors. So that's a sign to you, I hope, that we are using this toolkit effectively, and we're using it to lower volatility and to increase consistency and to obviously protect on the downside. And then the other benefit of all this, obviously, is hopefully these funds should produce returns that are not highly correlated to the overall market. And I think this is a general statement for a large number of hedge fund managers in South Africa. So, I mean, I've obviously got our funds up here as an example, but I think you could probably put in a number of other hedge fund managers in South Africa and get a similar picture. And the appeal of that, obviously, is that by adding a hedge fund to your overall client portfolio, you're going to be adding something that isn't highly correlated to what's in there already, and something that can give you a return profile that's different to the existing funds that you have in your investment book. So, key takeaways for today, I think I've got to say to you that a hedge fund is just a vehicle. It has these additional tools in the toolkit, but it's then a question of being able to assess, can the manager who's running this fund use those tools in a way that is compliant with what you as the investor want out of them, that is in compliance with their mandate, and isn't introducing additional unseen risk to the portfolio. So it's a question of making sure that they have the skills to utilize these tools available to them in the best way possible. Thanks for tuning in.